We are also benefiting from the rapid growth of AI, especially in our semiconductor sector. But the broader geopolitical environment remains uncertain.
Hello, everyone, and welcome to the Week Ahead on Nomura podcast. My name is Ewan Paracuelas, Chief Southeast Asia Economist at Nomura based in Singapore, and today is Friday, the 14th of August. Markets spent another week searching for clarity, which seems to be in short supply everywhere. US-Iran talks made little headway over the reopening of the Strait of Hormuz, even as President Trump declared that the US has total control. Meanwhile, the AI trade regained momentum, with semiconductor and AI infrastructure stocks helping lift global equities. Singapore Prime Minister Lawrence Wong mentioned those two opposing forces aptly in his National Day speech earlier this week, as you heard in that clip. Softer U.S. inflation reduced expectations of a Fed hike in September, and amid the geopolitical uncertainty, gold prices have been on the move again, now above 4,300 after a strong rebound over the past month, while Brent crude oil is hovering just below $90. It's a relatively light data calendar in the week ahead, but I'll check in with my colleagues who will cover some of those themes. Jeremy Schwartz discusses the implications of the latest US inflation data and what we might expect from the upcoming FOMC minutes. Josie Anderson previews the UK CPI data and Riksbank decision. Jing Wang focuses on the next round of Tier 1 activity data in China and prospects of fiscal stimulus by Beijing. I will then outline our expectations of Bank Indonesia's next policy rate decision, the first one since the shock resignation of its former governor, so should be interesting to watch. And finally, we have a special guest, Akshay Prasad, who is Managing Director and Head of Investment Products and Advisory Solutions at Nomura's International Wealth Management Business, or IWM. We cover a lot of ground in the discussion, from new initiatives in IWM to portfolio construction under volatile market conditions and harnessing the power of technology, as well as his views on major themes like AI concentration risks, gold prices, and rates markets. So don't miss that. Enough from me, and let's get stuck in. All right, let's kick off with the US, and Jeremy is joining me here. Hey, Jeremy, great to have you back in the podcast, and thanks for making time.
Hey, you've been great to be back.
So it's a very light data calendar in the week ahead. So let's just start, I guess, with a review of the CPI numbers that just came out this week. That seemed to have led to markets pricing out some of the probability of a Fed hike in September. So what do you make of that outturn, and also bearing in mind the NFP numbers were surprising to the downside before that?
Yeah, so core CPI came in very close to consensus, rebounding to 0.215% month on month. Taking that and this morning's PPI data together, we're currently forecasting core PCE inflation of 0.234% month on month. So probably a little bit uncomfortable for some Fed officials, but close enough to that 0.2% threshold that many officials have indicated as being consistent with this patient wait-and-see approach. In terms of the details, there were some things to be concerned about for the hawks. Notably in CPI, we saw some acceleration in inflation for tech-related items, so computers and peripherals, wireless phones, toys. So I think all of those could raise concerns that you are getting this demand-driven inflation because of the AI investment boom, leading to global memory chip shortages. But that said, the top-line numbers look consistent with a pause. And as you mentioned, with NFP surprising on the downside last week, we think that the growth momentum story is also going to be kind of supportive of a more patient approach. We think that the overheating narrative from earlier in the year hasn't entirely gone away, but the second derivative does seem to be turning. Momentum is cooling on the growth and inflation side, and we do think that that will support a patient wait-and-see approach.
And of course, does that give you a bit more conviction to your call that the Fed will stay on hold rest of the year?
Yeah, so it's been supportive of that, and you've seen the market move in that direction as well. The risks remain one way. So growth is strong, capex is booming, and inflation does remain well above target. But again, we think it's difficult to really sustain a kind of challenge to the Fed's credibility, either from markets or other Fed officials, when the data is at least trending in the right direction. And we think that that has begun in the past few months, and it is likely to continue.
Okay, got it. And the only one that I see on the calendar is really the FOMC minutes. So how important will that release be? And to your mind, what will you be looking for in that release?
Yeah, so as you mentioned, the calendar goes quiet for a few weeks into the end of the summer. The minutes will be interesting, partly because of Chair Warsh's very unusual press conference at the July meeting. We've seen a decent amount of Fed speak since then, and I think a lot of officials have pushed back either substantively or stylistically against some of Warsh's points. So I think two things we'll be looking out for. The first is whether Warsh had kind of any support for some of his more unusual points, things like downplaying the importance of tier one inflation indicators. But then beyond that as well, since Warsh didn't clarify it so much in the presser, we'll be looking at how much the kind of downside surprise in June CPI impacted the decision to stay on hold, and then what officials talked about as the potential threshold for future rate hikes. If you recall in the press conference, Warsh seemed to imply that the most recent inflation data didn't have much impact at all. He said the problem with data dependence is the data and the dependence, which was a somewhat unusual turn of phrase. But we think most other officials probably did have in mind some threshold, some target for what would leave them comfortable staying on hold. So we'll be looking for any color on that, and in particular, what the division is between the hawks and doves in terms of how they're characterizing the recent data.
Okay, great. So still something to watch out for. In keeping with a relatively light calendar, we can keep this short and sweet and end here. Jeremy, thanks. Fantastic as always.
Yeah, thanks. Great to be back.
Okay, swinging over to London, I'm joined by Josie. Josie, welcome back to the podcast. Thanks again for your time.
Thanks for having me, Eubin.
Right, let's start with the UK, where we get the July CPI data next week, and there's some labor market data as well. So what do you expect there, and is there any implications from that for the Bank of England?
Yeah, thanks. If I start on the labour market report, if we think back to last month, it was an encouraging report, really. It showed a static unemployment rate and only a small fall in payrolls. But then this month, we actually expect the unemployment rate to inch up slightly to 5%, and also a 10K fall in payroll. So that would be a slightly softer report that we're expecting. And then also on UK inflation, we get that next week for July. And one interesting quirk of the way prices are set in the UK is that the Ofgem, which is the regulator for energy, it has a price cap for household energy bills, and so they can only change once a quarter. And July is a month where they can change. And actually, this print is the first time we will see the impact of the Iran war and higher wholesale energy prices actually feed through to UK inflation, because the April change wasn't, it didn't. It really incorporate any increase as a result of the Iran war. So we've got a 13% month-on-month rise in household energy bills that will feed through into that July inflation print. So UK inflation has actually been looking slightly softer than many expected, despite the Iran war in recent months. But now we're expecting a pickup in July, and the Ofgem energy price cap increase will be a large part of that. In terms of what that means for the Bank of England, well, of course, any acceleration in inflation, the Bank of England will clearly be able to disentangle what just was that Ofgem energy price cap element from it. And so it will be able to look through the impacts of that, really. And a slightly softer labour market report, as is what we're expecting. They are looking at the labour market closely. They don't want to see the unemployment rate rise too much by keeping their policy restrictive. But ultimately, if the numbers come out broadly in line with what we're expecting, we will definitely be keeping our call of no change in rates this year the same.
Right. Okay, great. So looking through some of the lagged adjustments from the energy price shock, and then focusing a bit more on the labor market numbers. Speaking of central banks, for next week, we've got one, and that's Riksbank. Could they signal bringing forward a hike?
Yeah, so Sweden's actually been interesting this year because despite being exposed to higher energy prices, inflation in Sweden has been very weak and it's been below 2% in particular, even adjusting for tax and also excluding energy, that measure has been below 2% for every month this year. And well, in Sweden, they've had a number of tax changes. There was the halving of food VAT this year, and also there's been things like fuel duty cuts in light of the Iran war. But even after they have lowered inflation, if we exclude them, inflation has looked quite soft in Sweden this year. And so the Riksbank has not raised its policy rate, and we also don't expect it to raise its policy rate this year, despite it being fairly accommodative at 1.75% when the Riksbank sees the neutral range, when it's neither causing upward or downward pressure really on the economy, is 1.5 to 3%, so it's at the lower end of that currently. That being said, as I said, Sweden is exposed to an energy price shock, and it will experience price pressures as a result of higher wholesale energy prices. And also, Sweden is part of the EU. Has close economic ties to the euro area, and the ECB has already raised its rate once, and we think it will again in September. So Sweden isn't immune to pressures from that either. And also, Sweden's economy has been extremely resilient in terms of economic activity to the Iran war, and we actually saw in the first estimate GDP growth in Q2 rise quite substantially by 1.4% quarter on quarter. And so these reasons for a potential rate hike are adding up, but there's certainly not enough inflation pressure currently to vote for one in August.
Okay, got it. And then finally, any quick takeaways from Norges Bank's decision today?
Yeah, so there was a lot of anticipation heading into this decision because Norges Bank has been very clear so far this year that it will not tolerate the stickiness of inflation that we've seen. Even aside from the Iran war, underlying inflation has been around 3% for far too long. And Norges Bank raised its policy rate in May, I think, primarily because of that sticky inflation, not even because of pressures from the Iran war. And it signaled at its last meeting in June that another rate hike in August was pretty likely. It suggested around a 50% chance of it happening in August in its policy rate projection, but certainly in Q3. But then since then, we've had two downside inflation surprises, particularly looking very soft compared to Norges Bank's own forecasts. And so we took out the expectation that we previously had for an August rate hike, and indeed they left rates unchanged today, but they did say that it is too early to conclude that the inflation outlook has changed materially, and so they could still raise the policy rate this year. So we have kept our expectation of a policy rate hike, but we have pushed it out to November so that they have more time to assess inflation prints in the coming months.
Okay, very clear. That's fantastic. Thanks, Josie.
Thank you.
Now, my next guest is Jing Wang from our China economics team in Hong Kong. Hey, Jing, welcome back and thanks for joining.
Yeah, glad to be back again. Thanks, Yuven.
Great. No, but glad to have you here. We can do a bit of a health check of the Chinese economy. And it's an important week because next week we have a bunch of activity data for the month of July. So if you can walk us through some of your expectations from there, that would be great.
Yeah, sure. Yeah, so next week we will have a bunch of this major activity data for July, including industrial production, retail sales, and the fixed asset investment. Let me just walk you through for each. Now, for industrial production, we expect its year-on-year growth to remain fairly robust at 5.0%. Year-on-year. So that means just modest slowdown from 5.3% in June. So we already had the July export growth data this week, which remained quite elevated at 24% year-on-year, only down slightly from 27% in June. So the still strong export growth should provide a backstop to industrial production. But on the other hand, we expect the retail sales and the fixed asset investment to remain sluggish. We expect a weak rebound in the retail sales growth to 1.5% year-on-year in July from 1% in June. But that's just mainly because of low base from last year. The underlying momentum of consumption is still quite weak. Based on the high frequency data, we are still seeing steep contraction in the auto sales. And that's mainly because of this payback effects from the durable goods trading program. For the fixed asset investment, we expect contraction to persist at around -8% year-on-year because we are still having this continued contraction in the property investment, and also the policy effort remain relatively subdued. So overall, we expect July's data to display another month of big divide between robust production and weak demand, especially weak domestic demand. So for China's economy, we already have a sharp growth slowdown in the second quarter of this year from the first quarter. Now we are saying, this slowdown may have extended into July. So given this weak growth momentum in July and also still limited policy support in the near term, so recently we lowered our Q3 GDP growth forecast to 4.3% year-on-year from 4.5% before.
Okay, got it. So sounds like still more of the same in terms of the weak economic momentum sustaining into Q3. You mentioned policy support. So let's say that view continues to play out, and your expectations of the data show that kind of divide or K-shaped economy, if you will. How does that affect your view in terms of prospects of Beijing announcing some form of fiscal support measures? Again, taking into account the overall health of the economy.
So on the policy outlook, we think Beijing, the government is clearly getting more concerned, as we see from the policy tone adjustment at the July Politburo meeting. But based on the patterns over the past couple of years, we think the government is likely to announce more concrete pro-growth policy measures in September or in October. So that means, the policy impact is more likely to show up in Q4. So that's also a key reason why we lowered our Q3 GDP growth forecast. And in terms of policy implementation, we still believe the government will rely more on the fiscal policy measures because the monetary policy, is reaching its limit, and the space is also quite limited. And for the fiscal policy, we don't think the government will introduce a large supplementary budget for just a couple of reasons. Number one, they already announced a relatively large package of budget at the beginning of this year. And the problem was, government bond issuance or fiscal spending was much weaker than expected in the second quarter. So that, lead to a fiscal tightening. So this means what the government needs to do right now is just to speed up spending and just to unwind the fiscal tightening. The second reason we think is that exports remain quite strong. That will just discourage the policymakers to announce a big package of stimulus. So we think overall, the government will do something in the second half of this year, but we should not, put high hope for a big package of policy support.
Okay, got it. That's very clear. So nothing too urgent at the moment from the fiscal side. Okay, great. Let's leave it here. Thanks again, Jing.
Thank you.
Now, for the rest of Asia, just a couple of things to flag. In Indonesia, which has been in focus of late, we will have the BI policy rate decision, the first meeting where acting Governor Destri Damayanti is at the helm after the sudden resignation of former Governor Perry Warjio. She has been nominated as the sole candidate to be appointed governor by President Prabowo to Parliament. And this was a headline that was well received by markets. In terms of our expectation, we think BI will lead the policy rate unchanged at 5.75%, as we think it already turned a little dovish in the previous meeting. And the acting governor is likely to promote policy continuity under the existing framework of Bank Indonesia. However, we would also expect BI to continue to emphasize the implementation of macroprudential easing measures to support growth, as well as maintain its double-digit money supply target to support liquidity conditions as well. The acting governor is also likely to signal increased coordination with the government. So net could come out a little bit on the dovish side. Secondly, in Thailand, we have the second quarter GDP number. And unlike peers, which are also small open economies in the region, we think in Thailand it will disappoint and show lackluster economic performance, reflecting Thailand's vulnerability to the energy price shock and limited benefits from the AI investment boom so far. So we expect the Q2 GDP print to slow to 1.8% year on year from 2.8% in Q1, driven by weak manufacturing output, particularly in cars and refined petroleum products, while the Iran war and high energy prices dampened tourist arrivals. If that number comes out as expected, then this should support further our view that the BOT will keep the policy rate unchanged later this month. So not warranting any hikes, and we expect BOT to remain firmly on hold throughout the rest of the year. Okay, finally for our special segment, I'm really glad that I'm joined by Akshay Prasad, who is our Managing Director and Head of Investment Products and Advisory Solutions at Nomura's fast-growing IWM business here in Singapore. Hey, Akshay, welcome to the podcast, and thanks very much for your time. Really appreciate it.
Thanks, Ewan. Great to be here.
Cool. So I'll start with some views from you on some of these market themes and the stuff that you do. So as you know, things have been very volatile. There's a lot of things that markets are grappling with, whether it's higher rates or geopolitical tensions or tech concentration risks. How are you thinking about portfolio construction, and what are you seeing from investors in these things?
Yeah, great question. What a year, right? We've come from a pretty strong equity market last year, and seeing the melt up this year has been just phenomenal. We are a little over halfway through, and we still have some really important events to look towards, in particular the midterms in the US. In our view, I think the themes you highlighted will likely stay with us for the rest of the year. I think the biggest thing on investors' mind is tech concentration. Damned if you do, damned if you don't kind of situation. The good news is that the earnings have been great, and investors have been rewarded for staying true to the theme. But equally, we see broader indices fare quite well as well. MSCI World is at an all-time high. Equally weighted S&P has performed in line with tech. So from a portfolio construction standpoint, it gives room to diversify allocations and not just remain concentrated in a narrow area of tech, though outsized returns and risks will stay in that space. So it's a high-risk, high-return game there. Our job is to build compounding returns over the medium term, and wealth preservation there is fundamental to that. So we would continue to guide towards Japan, Europe, China. One can play the emergent themes from a much wider geographical vantage point. In fact, Asia provides a very interesting space to play this. We like healthcare, defense, financials, which are other key preferred areas if we are talking about equities only. Away from equities, we quite like hedge funds. So multi-strat hedge funds, we like private equity secondaries, we like special sits in credit, particularly watching what's happening in private credit and if opportunities come from there. And we like private infrastructure. And most importantly, we like gold. We've seen the precious group of metals complex, gold being our preferred choice, recover. And I think it will continue to play an important role as a ballast in portfolios.
Oh, great. That's a nice segue to my next question. And, this headline from Nomura IWM, which just recently launched a physical gold trading and custody services here in Singapore. So just want to ask, what is the idea behind that initiative and what are we trying to achieve here?
Yeah, so we've been active in the paper gold space with our clients for quite some time. Gold has thematically been on trend for a couple of years now. And it made a lot of sense for us to offer a safe haven product in a format that our clients could hold strategically from a country that is deepening its own strategic positioning in gold clearing and custody. So we are responding to client demand in some respect. But I think this will be a key differentiator in portfolios to be held medium term, very much in line with our asset allocation views and our market views in this space.
Okay, got it. And of course, gold prices have been rebounding recently. This is a very interesting timing for doing the launch. So just to get your views, what do you think is driving that rebound on gold and how do you see prospects over the more medium term?
So we think gold has become an important pressure release in markets, given what's happening in the US yield curve and the increasing opacity at the Fed, right? Early days. And while, we did see a significant pullback in gold recently, but that was after a very strong run-up and an overextension of positioning. So we think structural buying of gold by central banks will continue to persist. And we're quite concerned about the long end of the US rates as it responds to the new Fed and the continuing geopolitical turmoil, right? So more uncertainty, I think, will likely support gold prices in the medium term and prices.
Okay, yeah, clear. And I guess you mentioned earlier about tech concentration risks. So how do you think about diversifying, when there's that concentration and there's only a handful of names that's really driving their returns in the equity markets?
Yeah, I mean, it's been a tough one because, when you see such strong performance in a small part of the market, it becomes obviously extremely attractive. But I think the biggest thing that we've been contending with and advising clients on is sizing. Right, that's the hardest aspect of allocating portfolios right now. The concentration and at times the speed of the move makes it really hard to keep up with position trimming and right sizing the allocations. But it's really important, to work with clients in sort of defining what the original investment returns thesis was and trimming back accordingly. We also, quite cognizant of the increase in leveraged ETFs that have come across in markets, and that has changed the market structure in a lot of places. And I think, our view has always been understanding market structure. I think is fundamental to being able to not only generate returns but preserving those returns. Korea markets are a really good example of this, right? So we saw a significant upswing and downswing in that regard. And finally, on quality, we are looking across two larger names, and that have shown ability to generate strong cash flows, and we think they will, over the medium term, continue to not only participate in the market rally, but also be strong bellwethers in the portfolio. So we are keen to broaden our exposure globally, have several key themes across markets that we are speaking to clients about, some of which I mentioned earlier in our asset allocation views. We are also putting on spread hedges in equity portfolios. The swing, back up after the recent pullback in the high velocity parts of the market, of the equity market in particular tech, is forming a good setup of staying long but building put spreads into portfolios to protect against overcrowding in the market.
Yeah, okay, makes sense. And just to broaden it out a bit, any other major market themes that you're watching most closely these days?
So we think rates is probably the one that can really wag this dog, right? So rates development, in particular in the US, in Japan, and oil prices that directly feeds into that rates curve matrix in some ways is really important to watch. In fact, rates may be a good hedge to equities and hyperscalers CapEx spending through issuance. That's the one to watch, I think.
Okay, great. We've covered a lot of ground so far. So just final question, actually, for you. In terms of Nomura's IWM business, we've been investing into a lot of digital tools to support advisory decisions. So how is tech and harnessing the power of tech changing the way you and your team construct and monitor portfolios?
Yeah, never before has there been so much democratization of compute being provided to people, right? So Nomura in general, I found it's a huge enabler of new areas of exploration in this space, right? So without giving away too much of the secret sauce, so we've developed our own proprietary LLM that is a sum total of all our investment knowledge and is live at any point in time. And that's beginning to interface with portfolios to highlight important intersections of our thoughts on the market and the next best actions versus whether portfolios are showing over/under allocation or significant moves, right? But these are directed to direct attention of the advisors and make them sharper with clients. What excites me is that despite all that the digital tools can already do, it feels like we are in the infancy of what this technology will ultimately be able to achieve and be ultimately a net benefit to our clients. A stronger framework of advice in a much tighter, cleaner, and bespoke delivery that can be actioned by the clients, right? So I think that's what the forward looks like for us.
Okay, great. Yeah, really interesting stuff. This has been excellent. Thanks very much, Akshay, and come back soon.
Look forward to it. Thank you.
Well, that's it for now, and thank you again for listening to our podcast, edited and produced by John Dalton. Please like and subscribe to Nomura's podcast from your usual provider. We'd love to hear your feedback, so please feel free to write a review and share this podcast to anyone you think might be interested. You can check out NomuraConnects.com for more of our research and updates. Have a great week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.